This is Satya Pradyaman of Cirrus Research. The latest signals report is just out. The title, War Amplifies Rotational Market. And what this report gets to are some of the conditions that's been underlying in the last year, that we have seen a market broadening, a rotational market. A lot of that is because the current backdrop with the sort of fractious trading world, those are the elements that are sort of setting up for a valuation sensitivity. As a result, U.S. large mega caps, terribly expensive. Emerging markets, international markets, U.S. small caps, very discounted. That broadening has been underway for a year. The Iran strike actually puts a pause on some of those elements, but nonetheless, we remain in a defensive, valuation-centric posture. In this instance, what we are seeing is the commodity groups run up, a threat to inflation, and again, a potential risk to rising rates, which means valuation sensitivity. So to some degree, this rotational market, it's spinning on a slightly different axis, but remains in the same fraction. When we look at our equity asset allocation model, it remains terribly underweight. A lot of this has to do with the rich multiples that we're seeing. A lot of it also has to do with the volatility that's been rising. In addition to that, our style oscillator, that's a look between chasing growth stocks versus overweighting value stocks. This reading remains squarely in a value-leaned posture. Some of the months it's been overweight, some of the months it's been lean value. So at the heart of this is this idea that you have a more defensive sort of investor, and that's what's sort of pushing this idea about earnings, an earnings-driven market effectively. Also, what we have noticed is that some of the elements that drove this pullback in the last few months in terms of risk appetites, those have started to reverse course as investors are becoming a bit more bearish, a bit more scared. So the risk measure is declining. So we're no longer in the speculative world. However, as the risk appetites continue to decay, there's a good chance this continues to falter further. So we're going to keep an eye on this. This underscores, though, this nature of broadening a rotation. And then finally, this idea of smaller caps having done so well in the last 12 months or so. What we are noticing is now much more of a sort of crowded U.S. small cap market. A lot of this is driven by healthcare, biotech, and industrials. While the biotech names really are pretty sizable, it's the industrial small cap names we're concerned with because those multiples are especially excessive compared to how they've traded historically. Take a look at the full report, and if you've got any questions, feel free to reach out. Thanks.